Pepkor has posted an 8.7% fall in full-year profit. That's as the discount retailer felt the pinch of elevated debtors' costs and net finance costs. The firm also had to contend with increased power cuts. Load shedding resulted in lost trading hours, more than doubling to 845,000 hours, and diesel costs rising 69% to 141 million rand. Pepkor says 84% of its stores are now equipped with alternative power, but these measures are only effective up to a certain stage of load shedding, and the power outages still affect customer movement, activity and spending. A dividend of 48 cents has been declared, which is 13% lower than the previous payout. Looking ahead, Pepkor has stated that the success of its first quarter will be reliant on its performance during the festive season and back-to-school trade. The group has also flagged disruptions at local ports as one of its challenges going forward, as it is impacting stock inflows. Naspers has more than doubled its half-year profit. The technology investor has posted a 112% jump in core headline earnings per share. A better performance at its e-commerce unit and China's Tencent supported the growth. Given this, Naspers says it can advance its Prosus e-commerce profitability target by 6 months to the second half of 2024. Taking a look at Prosus in more detail, for the half year, the firm, which is majority owned by Naspers, posted a 118% surge in core headline earnings. That's due to a better performance from its e-commerce investments. A statement from the group says that after years of investment and growth, the businesses are now at scale and so are demonstrating improved profitability. Exceptional, that's how Vukile has described its half-year results. The commercial property group benefited from a strong showing in both South Africa and Spain, and this translated into a 10% rise in the firm's interim dividend to 52 cents per share and a 5.2% rise in fund from operations. This performance has prompted the group to up its full-year guidance. Dividend per share growth is seen at between 8 and 10%. This will equate to a full-year payout of around 121 cents. Fund from operations per share is expected to rise between 4 and 6%. Fairvest has had a good year. The property firm CEO Darren Wilder says the company has made excellent progress in de-risking the group's balance sheet, reducing vacancies and disposing of non-core assets. And all of this has been done in a difficult trading environment characterized by weak economic growth, high interest rates and sustained load shedding. During the year, total disposals amounted to just under 1 billion rand. The funds helped reduce borrowings, with Fairvest's net debt ratio reducing from 33.3% from 38.1% previously. Exxaro plans to sell its ferroalloys unit. It says the disposal process will target black ownership and should be wrapped up by the end of June next year. The coal miner has recently diversified into renewable energy and is looking for battery metal assets. Given this shift, the firm believes that the ferroalloys division doesn't fit into its long-term strategy. Exxaro has also provided the market with a production update. The miner expects coal output to be flat at 43 million metric tons in the year to end December. This is in line with previous guidance. Export sales are also seen flat this year at just over 5 million tons due to persistent freight rail logistics challenges. Sibanye-Stillwater is on a cost-cutting drive, and this will result in the miner restructuring its U.S. platinum operations. As a result, it will lay off 100 employees and 187 contract workers across the group's sites. The firm has blamed a lower palladium price environment and rising costs as reasons for the decision. Sibanye says the move will not affect production. Today's announcement follows the miner's decision last month to restructure its South African PGM operations. That process could result in the loss of close to 4,100 jobs. Richemont says it's carefully monitoring the situation at Farfetch. That's after Farfetch announced that it wouldn't publish third quarter results, which were due today. And the online luxury retailer's founder has been quoted as saying that he is considering taking the company private. Given this, Richemont says it would like to remind shareholders that the Cartier owner has no financial obligation to Farfetch and does not see itself lending or investing into the company. This comes as Richemont is set to sell a majority stake in Yoox Net-a-Porter to Farfetch. That deal has received all the regulatory approval it needs, but is still subject to certain other conditions that still need to be met. Richemont has stated that it is now reviewing its options with regards to the transaction. Grindrod Shipping is wilting away at its debt pile. A third quarter update from the maritime transport service provider shows that it has paid $36.1 million in bank debt since the start of the year. This has resulted in a reduction in interest payments of 1.9 million rand on an annual basis. Moving forward, the company's CEO Edward Buttery says it will continue to focus on debt reduction. The actions of staff who colluded with a criminal syndicate to circumvent exchange control and anti-money laundering controls have cut deep. That's according to Sasfin CEO Michael Sassoon. Writing in the group's annual report, the head of the bank and wealth management company commented that the impact of the syndicate has been felt deeply and has strengthened the firm's resolve to detect and prevent attempts at financial crime abuse. The issue was brought to light earlier this year when Al Jazeera reported that staff of Sasfin and two other banks had been on the payroll of Mohammed Khan, an alleged accomplice of cigarette magnate Simon Rudland, who is alleged to be the kingpin behind multiple Zimbabwean gold smuggling gangs. The Daily Maverick also published an investigation into how Sasfin was involved in helping Rudland and associates launder money linked to illegal tobacco smuggling. The reports prompted regulators to conduct their own investigation, which has resulted in allegations of non-compliance by Sasfin. This means that the firm will face remediation steps and could even be subject to potential sanctions. On the international front, the West has been quite adamant on de-risking their economies from China. For further detail on how that has progressed, it's over to our reporter Ndawuleng Lachela and the DW team.
That's right, Zinati. In a major policy shift, the West has, for the last few months, put some effort in de-risking their economies from China. The EU has taken the lead and the US has been following suit. And joining me now to discuss this move in greater detail is DW correspondent Lars Halter. Thanks for your time today. Now, Lars, how is this de-risking affecting the Chinese economy?
Yeah, thanks for having me. It is quite a change we've seen in how the West is treating China. I'd like to share an anecdote I just heard from a manager in the furniture industry. He gave an interview and he said, we used to have a China +1 strategy. Pretty much everything came from China, but there was a bit of a backup. And now, he says, there's a +10 and China strategy, meaning there's lots of suppliers that are playing major parts in a company's supply chain, and then there's only a little bit from China on top of all that. No wonder recent economic data out of China reflects that. Let's look at some details. Latest surveys have shown manufacturing unexpectedly contracting in October, and exports have accelerated their decline as well. For the July to September quarter, we've seen that a couple of days ago, China has recorded its first ever quarterly deficit in foreign direct investment, meaning foreign companies have actually reduced their stake in Chinese companies by more than they invested. It's all the more dramatic as this title change came so quickly. Less than 2 years ago, foreign direct investments showed an inflow of more than $100 billion in a single quarter. And that quickly dropped to 40 and then 20, and now it stands at a negative 12 billion.
Lars, can you now just talk to us about what all this data means for the future of China's economy?
So the technical answer is, of course, that this trend would further weaken the yuan and clip China's economic growth potential in the long run. But there's also a more philosophical question. Can this trend change Beijing's geopolitical and economic policy? And maybe, I guess, because for years businesses have expressed worries about regulations in China and the fact that they're not playing on a level playing field there. And while Beijing has said again and again that they would be willing to change their ways, and that they would work towards opening up their markets and commit to a sort of a fair play economy, it has never happened. Now, unfavorable economic trends might force the government to change, at least to some degree, lest they lose even more foreign business, because that could definitely threaten the economic growth the country has seen over decades, and it could also threaten Xi Jinping's legacy.
And is there any hope for Beijing that the recent trends could reverse?
There is indeed, because nothing in the world is ever 100%. Now, most businesses are looking at China as an immensely important part of their supply chain. Too important, in fact, and that's where the de-risking happens. Tech, autos, machinery. Countries and companies in the West don't want to depend on China when it comes to goods they need, because they don't trust Beijing. But of course, China is not only a supplier to the West, China is also a customer. And even though economic growth has been weakening in China, the consumer is still there and doing much better than they used to. So if you're in the consumer business, China is still an attractive market. Like for McDonald's, they said last week they would boost their stake in China. Also, a major European hotel chain has just said they would reinvest profits in China for now. So depending on what business we're talking about, some investment is still flowing to China, and in a few sectors of the economy it is actually growing.
Let's leave it there. Always appreciate those insights. That was Lars Halter from Deutsche Welle.